Okay, let's unpack this. Imagine a company, right? It's reporting record revenues, profitability is way up, they've got this breakthrough technology. Sounds like a dream stock, yeah.
Absolutely, the kind everyone's looking for.
But here's the kicker. What if that same company is facing these really damning allegations of fraud, reports
Mhm.
of idle factories, and it's caught right in the middle of a U.S.-China trade war, threatening to just blow up the whole business model?
That's quite the contrast.
It really is. And this is the central question, the dilemma gripping investors around Microvast Holdings, Inc., ticker symbol MVST. Are its recent profits just, a mirage, masking huge operational flaws and these geopolitical time bombs? Or is it actually a deeply undervalued innovator right on the cusp of explosive growth?
That's the million-dollar question, or maybe $1 billion in this case.
Exactly. So today we're doing a deep dive into MVST. We'll analyze every part of it to give you a clear, data-driven perspective on this incredibly high-stakes stock. We're anchoring this to its closing price of $2.71 on August 22, 2025.
And what's particularly noteworthy here, I think, is that this isn't just about one stock. It's really a microcosm, a compelling case study of the big global challenges facing high-tech manufacturing right now.
Like what specifically?
Well, think about supply chain vulnerabilities, geopolitical tensions. It's all playing out here. So we'll guide you through this complex stuff, helping you understand not just what's happening at Microvast, but more importantly, why it matters for the wider economy and really for any company navigating these kinds of turbulent waters.
Yeah, good point.
And this deep dive is part of our ongoing commitment to explore all the S&P 500 stocks. We really appreciate our members on Stock Analytics AI who get priority access to these in-depth analyses.
Right. So to really get our heads around Microvast, we've broken this down into two parts. First, we'll dig into the fundamentals, the business itself, the management team, and the financials.
Laying the groundwork.
Exactly. Then we'll zoom out. Look at market sentiment, who owns the stock, the critical risks, and this is huge, and finally our overall conclusion. What does it all mean? Okay, let's dive right in. Chapter 1, Business Analysis. What makes Microvast tick?
Well, one of the most intriguing things about Microvast is its commitment to vertical integration.
Meaning they do everything themselves.
Pretty much. Think of it this way. They control almost every step from the initial R&D, like the chemical components, all the way to assembling the final battery pack.
Why do that? Seems complex.
It is, but it's strategic. It's about ensuring quality, controlling cost, which is vital, and speeding up innovation, really getting new tech out faster.
Okay. And how do they make money?
Their revenue model is pretty distinct. They aren't selling directly to you or me. They primarily sell their battery systems and components to big OEMs, original equipment manufacturers, the large vehicle makers, and also system integrators.
And crucially, they've carved out a very specific niche, haven't they? They're not really going head-to-head in the main passenger EV market.
Exactly. They've strategically targeted commercial electric vehicles, buses, trucks, even those heavy-duty mining vehicles, and also utility-scale energy storage systems, ESS, big battery farms, essentially.
So what's the pitch to those customers? What do they offer?
It boils down to a kind of triad of performance. First, ultra-fast charging, often just 10 to 15 minutes. That's huge for commercial use.
Definitely. Downtime costs money.
Right. Second, long cycle life, which means the batteries last longer, lowering the total cost of ownership over the vehicle's lifetime. And third, critically, superior safety. They use proprietary stuff like aramid separators and non-flammable electrolytes.
That sounds like a powerful value proposition, especially in those demanding sectors.
It truly is. However, and this is a crucial point, it'll come up again, while Microvast is headquartered in Texas, its most critical manufacturing, the high-volume battery cell production, that's mainly in Huzhou, China.
Ah, so not just a global footprint, but a real dependency.
Precisely. It flags a significant strategic vulnerability right away. Now, their product portfolio includes things like their Gen 4 battery packs, the ME6 ESS. But looking ahead, they're pouring money into a potential game changer, a true all-solid-state battery, or ASSB.
Solid state. That's the holy grail, right? Safer, more energy dense.
That's the promise. Dramatically improved safety, maybe better performance, more design flexibility because you get rid of those flammable liquid electrolytes. It's a big bet for them.
Okay. Now, for the really compelling part, the market they're in, it's booming, isn't it?
Oh, absolutely explosive growth. The global EV battery market is projected to just skyrocket. We're talking from maybe $92 billion this year, 2025, to over $700 billion by 2034, almost an 8-fold increase.
Wow. What's driving that?
It's a combination of things: decarbonization efforts globally, much wider EV adoption, and falling battery costs making EVs more competitive.
But it's also a really tough market, right?
Right.
Cutthroat.
It's only. You've got giants like Tesla, Panasonic, LG Chem, Samsung SDI, BYD, huge players. So for Microvast to succeed, they have to differentiate. And that differentiation comes down to their technology.
The patents you mentioned.
Exactly. They hold over 810 patents, protecting unique chemistries, special cathode designs, those non-flammable electrolytes, the polyaramid separator. This IP, their intellectual property, that's their moat. That's their competitive barrier.
And once an OEM designs their battery in, it's hard to switch.
Moderately hard, yeah. Switching costs are significant. It involves redesigns, revalidation. So those initial design wins are incredibly valuable for long-term revenue streams.
Got it. What about regulations? How do they play into this?
Well, the regulatory environment is kind of a double-edged sword. On one hand, you have policies like the U.S. Inflation Reduction Act, the IRA. That creates huge demand and offers incentives for making batteries in the U.S. That's a clear opportunity, a tailwind.
But the other edge,
Protectionism. The same focus can lead to things like tariffs, which we'll definitely talk more about, and just generally increased geopolitical friction. It complicates things significantly.
and it's not easy to just jump into this market, I assume.
Not at all. The barriers to entry are formidable. You need billions in capital expenditures, CapEx, just to build the factories, years of intense R&D to even get the tech right. And then you have to secure reliable supply chains for raw materials and get customers to trust and validate your product.
Yeah.
Yeah. It's not for the faint of heart or the undercapitalized.
Okay, that sets the stage for the business. Let's move on. Chapter 2. Manage and evaluation. Who's running the show?
Leading the company is the founder, Yang Wu. He's been chairman and CEO since way back in 2006.
Does he have a track record?
He does, actually. Quite an impressive one. He previously founded a company called Omex Environmental Engineering and sold it to Dow Chemical for what's reported as a 55-fold return. So, successful entrepreneurial background.
That counts for something. And the tech side?
Their CTO, Dr. Wenwan Mattis, holds something like 97 patents herself. So it signals, strong technical leadership alongside that entrepreneurial drive from the CEO.
Okay, experienced leadership. But how do they handle crises? That often tells you a lot.
It really does. And this raises an important question because we see a tale of two very different responses here. Microvast faced a short seller report before from J Capital Research. Their response then, swift, forceful public rebuttal.
Okay, standard playbook.
Right. But now, compare that to the response or lack thereof to the more recent and arguably more detailed Grizzly research report that came out June 25th, 2025.
What's the response been this time?
Complete silence. Nothing.
Really, even with specific allegations?
Yeah. The Grizzly report makes very specific claims, things like citing on-the-ground observations of supposedly idle factories, for instance, in Germany. And it points to Chinese government documents that seem to contradict what the company said publicly.
And management hasn't addressed any of that.
No. They even had an earnings call on August 11th, after the report came out. No mention. That deliberate silence, well, it creates a pretty significant information vacuum. And frankly, it elevates the risk profile here considerably.
Yeah, that silence is unsettling. Okay, what about how they use their money? Capital allocation.
Well, Microvast is clearly all about aggressive organic growth. They've been pouring capital back into the business like crazy.
We saw those CapEx numbers rising.
Exactly. CapEx went from about $88 million in 2021 up to $151 million in 2022, and then nearly $190 million in 2023. Huge increases.
Where's that money going?
Primarily into expanding manufacturing capacity, especially at their main facility in Huzhou, China, and also for that project in Clarksville, Tennessee, which now seems stalled, according to reports.
And no dividends or buybacks?
No, none.
Yeah.
Which is typical, really, for a high-growth company at this stage. They're prioritizing scaling up, reinvesting everything.
Makes sense. So all that investment,
Yeah.
is it paying off? What about ROIC?
Return on invested capital, ROIC. This is fascinating. For years, Microvast's ROIC was deeply negative. They were spending far more than they were earning back on that capital.
Burning cash.
Right. And this is but for the trailing 12 months ending Q2 2025, it actually turned positive. Came in at 3.02%.
So a turnaround.
It's the quantitative signal, yes.
Mm-hmm.
It's the numbers reflecting the bull thesis. The idea that those massive investments are finally starting to generate real economic returns. The huge question, of course, is sustainability. Can they keep it up?
Let's get deeper into those numbers. Chapter 3, financial analysis. Where do things stand today?
Okay, so currently Microvast has a market capitalization around $885 million,
Which puts it where?
firmly in the small cap space,
Yeah.
which immediately tells you high growth potential maybe, but also high volatility and high risk. Think of it like a potential rocket ship, but one that could easily hit some serious turbulence, not like your big, stable blue chips.
Gotcha. And revenue growth, we touched on that.
Yeah, it's been strong and pretty consistent. Climbed from just over $100 million back in 2020 to nearly $380 million in 2024. And management's guiding for more growth in fiscal 25, targeting somewhere between $450 and $475 million. That's another 18-25% jump.
Okay, top line looks good. What about the bottom line? Profit margins.
Right, now here's where the story gets really interesting. This is the dramatic part of the financial narrative. Their gross margin, basically what's left after the cost of goods sold it, was deeply negative just a few years back.
Losing money on every battery sold.
Essentially, yeah.
Huh.
But it's climbed steadily, hit 31.5% for the full year 2024, peaked at 36.9% in Q1 of 2025 before settling back a bit to 34.7% in Q2. That's a huge improvement in the core profitability of their products.
That is dramatic. What about operating and net margins?
Similar story, mostly. They actually achieved a landmark GAAP net profit that's using standard accounting rules of $61.8 million in Q1 2025. First time, really.
Wow, so they figured it out.
Oh, wait, hold on. Because that was followed by a significant GAAP net loss of $106.1 million in Q2 2025.
Ouch. That's a big swing. What happened?
That Q2 loss definitely needs close scrutiny. We don't have all the details, but it raises questions. However, despite that GAAP loss, they did report positive adjusted EBITDA in both Q1 and Q2.
Adjusted EBITDA, so stripping out some items.
Right. Interest, taxes, depreciation, amortization, sometimes other adjustments. It suggests that on an operational level, stripping out some non-cash or one-off items, profitability is being sustained. But the official GAAP figures, definitely a mixed and somewhat concerning picture with that Q2 loss.
That swing from profit to a big loss, that's a critical point. What about cash flow? Were they burning cash before?
Historically, yes, absolutely. Common for companies scaling up heavy manufacturing. But another positive sign for the full fiscal year 2024, they actually generated positive cash flow from operations. Only $2.8 million, but positive is positive.
A vital sign, maybe, that the core business is starting to pay for itself.
Exactly. It suggests it's becoming self-sustaining from a cash perspective, which is crucial. Now, in terms of earnings consistency, well, there wasn't any until that brief Q1 2025 profit. So if you're investing here, it's really a bet on future consistency, not on a proven track record.
Understood. What about debt?
That's another point of concern. The debt-to-equity ratio. Reported figures vary a bit depending on the source, maybe 1.12, maybe 0.32. But the trend seems to be rising leverage. That definitely increases financial risk, especially in a capital-hungry industry like this.
And liquidity. Can they pay their bills?
This is maybe more critical right now. Their current ratio is 0.83.
Below 1.0.
Yeah, meaning current liabilities bills do soon exceed current assets, like cash and receivables. That signals a significant short-term liquidity risk. They might need to raise cash or find other ways to meet obligations.
Not a comfortable position.
And no dividends, as you said.
Correct. Reinvesting everything, which fits the growth story but offers no cushion for investors if things go sideways.
So putting all these mixed signals together,
Yeah.
how do you value this thing? That's the challenge. The trailing PE ratio, using past earnings, is negative because of historical losses, so it's meaningless. But if you look forward, using analyst consensus estimates, the forward PE for 2025 is around 16.9. And it's projected to fall to maybe 10.8 for 2026.
Which sounds cheap. If they hit those numbers.
If they hit those aggressive profit targets, yes. It could suggest the stock is inexpensive relative to its growth potential. But that's a big if.
What about intrinsic value, like with a DCF?
We looked at discounted cash flow, or DCF analysis, trying to estimate its true worth by projecting future cash flows and discounting them back. And for Microvast, the model spit out an incredibly wide range.
How wide?
Like from suggesting it's currently overvalued with a value around $1.77 per share, all the way up to analyst-derived targets implying significant upside, some reaching as high as $12.25 per share.
Wow. That's a huge gap. Why so much uncertainty?
It really highlights the binary nature of this. High risk, high reward. A lot depends on the assumptions you make. But a key factor driving that low end is the very high discount rate you have to apply.
Because of the risk.
Exactly. You factor in the stock's high volatility, its beta is over 3, meaning it moves much more wildly than the market. Plus, it's a small cap, it has that weak balance sheet we discussed, and those looming geopolitical risks. All that forces you to discount future cash flows much more heavily.
Okay, let's shift gears. We're moving into part 2 now. Let's look outside the company. Chapter 4, Market Sentiment. What's the mood out there regarding Microvast?
Well, what's particularly interesting here is the split. On one side, you have Wall Street analysts. They're generally optimistic.
What are they saying?
The consensus rating leans towards a buy, or even strong buy. The average 12-month price target is around $5.50. The range is maybe $5 to $6. So compared to the current $2.71, that implies pretty significant potential upside.
Any recent changes?
Yeah, notably, H.C. Wainwright actually doubled its target to $6 on August 13th, right after those Q2 results came out, despite the gap loss.
Interesting. So analysts are bullish. What about the broader media narrative?
That's where it gets highly polarized. You see bullish articles focusing on the financial turnaround, the record revenues, that Q1 profit beat, the solid-state battery potential, painting a very positive picture.
Yeah, and the bears.
They fixate on the grisly research allegations, the fraud claims, the operational failures. They highlight the extreme stock volatility and the company's history of needing funding. So two completely different stories being told.
Which leads us to the short interest, right? That really shows the battleground.
Absolutely. Short interest is a powerful indicator of negative sentiment investors betting the price will fall. And for Microvast, it's exceptionally high.
How high?
As of the end of July 2025, nearly 33 million shares were shorted.
Wow. What percentage is that?
It represents 13.82% of the company's float the shares available for public trading. To put that in perspective, that's more than double the average short interest for its peer group, which is around 5.3%.
So a lot of people are betting against it, making it a quintessential battleground stock.
Precisely. And that high short interest also sets the stage for a potential short squeeze. If good news hits, or the price starts rising for other reasons, those short sellers might be forced to buy back shares quickly to limit their losses, which can rapidly drive the price even higher. It adds another layer of volatility.
What about technical indicators, like moving averages?
They show some mixed signals too, reflecting this battleground status. The current stock price, $2.71, is significantly below its 50-day simple moving average, or SMA. That's around $3.31 to $3.42.
Meaning?
The SMA acts like a short-term trend line. Being below it suggests a downtrend recently, negative momentum in the short term.
But what about longer term?
Here's the mix. It's actually above its 200-day SMA, which is sitting between $2.21 and $2.59. That suggests that despite the recent weakness, the longer-term trend has been positive. So, short-term pain, but maybe a glimmer of long-term hope based on that indicator.
Okay, very interesting sentiment picture. Let's delve into Chapter 5, ownership structure. Who actually owns MVST? Who's making these bets?
Right, and if you dig a bit deeper here, you uncover a really compelling counter-narrative to that high short interest we just talked about.
Which is?
Aggressive accumulation by big institutional investors. As of June 30th, 2025, 137 institutions held about 75.3 million shares.
Who are these institutions? Any big names?
Oh yeah. Top holders include major players like BlackRock. They increased their holding by a staggering 164% recently. You've got Vanguard. Morgan Stanley, they boosted their stake by 805%. And State Street, up nearly 500%.
Wow. Those are huge increases. What does that tell you?
Well, these are the smart money firms, right? They have extensive research departments, do tons of due diligence. They were almost certainly aware of the grisly report and the short seller allegations.
So they bought anyway, heavily.
Exactly. Their aggressive buying suggests their own research led them to a bullish conclusion. They're effectively taking the other side of the trade against the short sellers. That provides a pretty strong point of validation for the bull case, you could argue.
That's a powerful signal, seeing the big players piling in. What about insiders, people running the company?
Insider ownership is also exceptionally high. Insiders collectively own roughly 30% of the company.
30%? That's huge.
It is. And the founder CEO, Yang Wu, is the single largest shareholder with about 84 million shares. That ensures his interests are strongly aligned with common shareholders. He has serious skin in the game.
Are insiders buying or selling?
That's another telling point. Over the last 12 months, there have been 19 open market purchases by insiders and basically 0 open market sales. There was one director sale way back in late 2023, but the overwhelming trend recently is accumulation.
Again, signaling strong internal confidence.
It certainly seems that way. So overall, ownership is highly concentrated. It's roughly an even split. Retail investors hold about 34%, insiders have that 30%, and institutions hold 31%. And the top 6 shareholders control roughly half the company.
Meaning their actions, buying or selling, can have a really outsized impact.
Definitely. It adds another layer of potential volatility, but also shows strong conviction from key stakeholders.
Okay, now for the really critical part, I think. Chapter 6, Risk Assessment. Let's break down the potential downsides. We can use a quick SWOT analysis: strengths, weaknesses, opportunities, threats. Let's start with internal factors, strengths and weaknesses.
Okay. Strengths are pretty clear from our discussion. First, their proprietary technology. The fast-charging, long-life, superior safety features. That's key.
Right.
Their vertical integration model gives them control. Their niche market-focused commercial EV and ESS avoids the most crowded space. And that aligned, validated ownership structure we just talked about, with the founder and institutions heavily invested.
Makes sense. Now the weaknesses.
Well, the big one is that history of unprofitability. That recent turnaround, as we said, isn't proven sustainable yet.
And the balance sheet.
Strained. That current ratio below 1.0 is a definite weakness, signaling liquidity concerns. Then there's the operational concentration in Huzhou, China. That's a huge geopolitical single point of failure. And they have previously disclosed material weaknesses in their internal financial controls, which raises flags about reporting reliability.
Okay, internal weaknesses noted. Now let's look externally. Opportunities and threats. What are the opportunities?
The biggest opportunity is simply the market itself. That massive, multi-trillion-dollar electrification trend. Microvast is playing in a huge sandbox.
Any others?
Yeah, there are market adjacencies potential to expand their tech into marine applications, data centers, robotics, areas needing reliable power. Their next-gen tech, especially that all-solid-state battery, if successful, could be a major game changer. And those onshoring incentives, like the IRA, present a clear opportunity to build a manufacturing footprint outside China, funded partly by the government.
Lots of potential upside, but the threats must be significant too.
Oh, they are. Intense competition from those much larger, better capitalized giants is a constant threat. Raw material price volatility, lithium, cobalt, graphite can wreck margins. But perhaps the most immediate and severe threat right now is that credibility crisis.
Stemming from the unanswered Grizzly allegations.
Exactly. That silence creates a cloud of doubt that's hard to ignore and could seriously damage investor confidence and even customer relationships.
And this is where it gets really interesting. The macro and geopolitical threats, these seem huge for Microvast.
They are arguably the biggest factor overshadowing everything else right now. Macro factors like high inflation, rising interest rates, those increase borrowing costs for Microvast and could dampen demand from their customers who might delay big capital projects. Standard economic headwinds.
But the geopolitical stuff is specific to them.
Very specific and potentially devastating. The single greatest threat is the geopolitical vice, specifically the 2025 U.S. tariffs.
Can you remind us what those are again?
They directly target key inputs and outputs for Microvast. Chinese graphite faces duties up to 93.5%. And crucially, Chinese-made lithium-ion EV batteries see tariffs jump from 7.5% all the way up to 25%. When you add it all up, cumulative duties could potentially exceed 100% on some components coming from China.
And Microvast's main factory is in China.
Precisely. It's a direct hit to their primary manufacturing hub and their entire cost structure. These tariffs threaten to either completely destroy the gross margins they just fought so hard to achieve, or force an incredibly costly and time-consuming relocation of their supply chain.
It's a terrible position to be in.
It gets worse. Compounding this, there are those allegations, highlighted by Grizzly, of potential ties to the Chinese Communist Party. If those allegations gain traction or are proven true, it could make Microvast ineligible for U.S. incentives, like the IRA funding.
The very funding meant to help companies escape dependency on China.
Exactly. They're operationally dependent on a nation being targeted by tariffs, and they might be blocked from the main escape route offered by U.S. policy. It's like being trapped between a rock and a hard place doesn't even cover it. It's an incredibly difficult, potentially existential threat.
Okay, wow. That really frames the stakes. Let's try to bring it all together. Chapter 7, conclusion. What's the final synthesis here? The bull versus bear case.
Right. The bull case really hinges on that clear financial inflection point we saw. Impressive revenue growth, the dramatic gross margin expansion, the recent profitability, even with the Q2 blip, and positive operating cash flow starting to emerge.
Plus the tech.
Plus the tech. They have a strong technological moat with proprietary features crucial for commercial needs, fast charging, safety, longevity, and that promising solid-state battery pipeline offers future upside. They're well-positioned in a high-value niche within a massive secular growth market.
And the ownership.
And that aligned, validated ownership. The founder with huge skin in the game and those top-tier institutional investors making large recent bets. That's a powerful combination for the bulls.
Okay, compelling bull case. But the bear case seems equally potent, maybe even more so given the recent developments.
It is potent, and it centers on those severe, unresolved risks. First and foremost, that crippling crisis of credibility from the unanswered grisly allegations. It hangs over everything.
Tariffs.
Second, that acute geopolitical vice. The 2025 U.S. tariffs directly threaten their core manufacturing model and profitability. It's a massive external shock. Third, there's significant execution risk. You have the allegations of failed U.S. expansion projects, plus their long history of burning cash before this recent turnaround.
And the financials aren't perfect either.
No. Fourth, the balance sheet is weak. That current ratio below 1.0 signals real liquidity concerns. And finally, fifth, they face that intense competition from industry giants who have far deeper pockets and established scale.
So what does this all mean for the valuation? Where does that leave us?
It means the intrinsic value is highly uncertain. As we saw, those DCF models give a huge range from $1.77 per share up to maybe $12.25. The bull case getting you towards the higher end hinges entirely on them disproving the fraud allegations, A&D successfully navigating the tariff nightmare. The bear case points firmly to the lower end, or worse, if those risks fully materialize.
So, bottom line, at its current price of $2.71.
At $2.71, Microvast is a classic high-risk, high-reward proposition. It is absolutely not for the faint of heart.
Yeah, you can say that again.
For the bullish thesis to actually play out from here, you need really high conviction. You have to believe the short seller allegations are false and that management has a credible, workable strategy to handle those severe tariffs without destroying the profitability they just found.
It sounds like the outcome depends less on spreadsheets and more on these big external factors.
I think that's exactly right. The outcome here is less about traditional financial modeling and much more about how these major non-financial uncertainties, the allegations, the geopolitics get resolved.
You know, this deep dive into Microvast really highlights the razor's edge so many innovative companies are walking today. When you're dealing with cutting-edge tech in a world that's so interconnected but also so politically fragmented, how much weight do you give the financial metrics versus those whispers of geopolitical risk and these serious unanswered allegations? It's a powerful question, I think, for any long-term investor to grapple with.
Absolutely. It's a perfect illustration of how modern investing demands you look far beyond just the balance sheet and the income statement sometimes. You have to understand the whole ecosystem.
Well, we hope this deep dive into Microvast has given you, our listeners, a clearer understanding of the immense opportunities, but also the very significant risks involved here. If you found this insightful, please do like and subscribe to the Stock Analytics AI YouTube channel. It really helps us out.
And remember, members on Stock Analytics AI get priority for deep dives on specific tickers. We're planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those analyses. It's just $4.99 a month. And hey, if you just want a one-off deep dive on a stock you're interested in, drop us a super thanks on the video.
Just a reminder, this analysis was generated by an AI system. It's for educational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.